In this video, I'll share the top 5 sectors worth investing in during the potential upcoming stagflation and recession. All these investments we're about to cover have proven themselves during the last stagflationary recession during the 70s, as well as all of the last several high inflationary periods. Stay until the end of the video, as the best is saved for last, and subscribe if you want to always have an investing edge. As always, all is said with educational purposes and is not meant as financial advice. The data source is Incrementum, one of the top analytical firms worldwide, and this is the graph which we'll examine in more depth. The higher, the better, and if we see the high sectors, which are also placed to the right, these have been historically the best. The worst quadrant is the one which is in the down left. So let's begin with the 5th best performing sector. The 5th best performing sector is the utilities sector. The utilities sector consists of companies which provide society with basic needs such as water and gas pipelines, electricity lines, and others alike. This sector, just like other sectors on the list, is very well protected to the downside in hard economic times. During recessions, people stop spending and cut down to only their basic needs. But it does not get any more basic than water, gas, and electricity. Anything less than that, and people will live in what is considered ultimate poverty. This is why the sector is very stable even when growth in the economy lags. The best performing stock from this sector over the last 5 to 10 years is NextEra Energy, which has had an annualized return over the period of around 18%. But always remember that past performance does not give any indication of future performance. And looked from a value investing lens, the current fundamentals behind NextEra Energy are not looking good. With a PE of over 40 and a debt-to-equity ratio of 1.2 and a 2.31% dividend yield, in general, it is good to note that almost all utility businesses have higher debt levels due to their massive physical assets, but such a high price-to-earnings ratio gives us a potentially very low future return. The debt-to-equity ratio is ideal to be below 1 according to Buffett and other great value investors. But when it comes to this sector, it is understandable for it to be a bit higher. Other notable mentions from this sector which have much better fundamentals are Duke Energy, which has a PE of 18 and a debt-to-equity ratio of 1.41. Again, they have high debt, but their earnings potential is much better, and also the dividend stands at 4.51%, which is almost twice as big. With even a lower PE is the American Electric Power Company with a 16.74. It pays a dividend of 3.67%, while its debt levels stand at 1.36. The third interesting stock from the sector is Echelon Corporation with a PE of 13.7 and a dividend of 3.64. The debt-to-equity ratio is 1.63. The 4th best performing sector is the consumer staples sector. The sector consists of companies which provide us, the consumers, with our most basic needs such as food, toiletry, drinks, medicines, and all other such products and services. During periods of a crisis, people tend to budget down, but the budget cannot go below our most basic needs, which consist of the just mentioned products and services. This makes the cash flows of these companies more stable. Another major positive is that most of the companies in this sector, at least the more established ones, pay dividends for a solid number of years. The dividend increases even more our long-term returns. To give precise examples of companies in this sector, we can mention Walmart, Pepsi, Coca-Cola, Walgreens, Costco, but if we have to narrow it down, in general, most of these companies are not worth it, as their prices are too high currently. Here, it is important to mention a favorite rule of Warren Buffett, which is never to confuse a good company with a good investment. All of these companies are tremendous, but their market caps are too high for their current fundamentals. This makes them good companies but bad investments. Looked from a value perspective, Walgreens has the lowest valuation, while the other mentioned companies have on average PEs of above 20. Walgreens has a PE of 6.6. This means that for each dollar of earnings, we pay only $6.6 for Walgreens, while for the others, we pay $20+ for each dollar of earnings. This makes it so that from Walgreens, our investment can yield 15.15% even with no growth. This is the current earnings yield we get from the current price. On top of that, due to the low price valuation, Walgreens' dividend is very high and it stands at 5.7%. This dividend is paid out before the net income is placed on the bottom line, which means that on top of the 15.15%, we can put another 5.7% annual return. We just cannot get that from most other consumer staple stocks, and the lower the valuation, the lower the risk and the higher the potential return. This is the true value investing way preached by Buffett and his mentor Benjamin Graham. To continue, we can now move on to the third best sector according to our historical data, and this is the precious metals and mining sector. It is important to note that only around 47% of the times this sector has managed to beat out the inflation rate and have a positive real return over stagflationary and inflationary times. But the data shows that when this sector performs well during these times, it shines brighter than anything else out there in terms of its returns. Here, the topic deserves a separate video, so don't forget to hit the bell icon, as this will make sure you get your daily dose of alpha. The precious metals sector consists of gold, silver, and platinum, but the data is mainly in regard to gold and silver. In the 47% of times when the sector outperforms, silver always outshines gold due to its higher volatility. In terms of miners, the sector is quite specific, and unlike other stock sectors, the knowledge that is needed to make proper analysis is very precise. For people who want to diversify in this sector and want higher potential returns than the ones which can be achieved by simply buying physical gold and silver, I would say check out some well-established ETFs in the space. Good examples are GDX and GDJX. The one with the J stands for Junior Miners ETF. The smaller the companies in the ETF, the higher the potential returns would be. But of course, the risk is also higher. Comment down below if you want a separate analysis of Barrick Gold and Newmont, which are the two biggest gold miners in the world. Overall, this sector has millennia-long history of protecting investors and consumers from currency debasements and direct war-like conflicts. Although, from a historical perspective, this can only be said for the physical metals, as stocks did not exist prior to a couple of hundred years ago. We have come to the second most well-performing sector from a historical perspective, and these are the equity REITs. REITs are funds which offer a diversified way of investing in real estate assets. Instead of owning one or two properties, REITs own a large number of properties, and this way the level of risk comes down. By law, REITs must pay out at least 90% of their income as dividends back to shareholders. But it is important to note that when it comes to REITs, the analysis, much like the precious metals sector, is very unique and different. For example, it is not correct to look at the price to income. We should look at the price to funds from operations, or FFO for short. FFO includes non-cash expenses such as amortization and depreciation, as well as it subtracts all gains and losses from the purchase or sale of existing properties. In other words, it is a much more comprehensive metric for analyzing the income flows of a REIT. The best US public REIT is Realty Income. It has one of the longest histories out of all REITs, and it has been paying out dividends for over 25 years straight. Instead of price to earnings for REITs, we must use the price to FFO metric. For Realty Income, it stands at 16.5. For comparison, the PE is 54. But again, it is not the correct metric to use. The dividend yield of Realty Income is 5.3%, which is on the high side from a historical lens, and it means that the current stock price is not very overvalued. Finally, we shall discuss the number one best performing equities sector during a stagflationary recession and an inflationary scenario, the energy stocks. They have a 73% chance of performing well in these types of times. And this sector also has the highest average real returns on an annualized basis. For sure, check out other videos on the channel about the energy crisis and the coal and oil markets. An interesting theme emerges here if we take a closer look. All of these 5 sectors are filled with well-established companies which offer basic needs to the consumers, and also all companies in these sectors pay dividends. The energy sector is no exception. The biggest companies in the sector are Chevron, Exxon, Buffett's favorite Occidental Petroleum. Other notable mentions are ConocoPhillips and Devon Energy. From outside of the US, the most interesting company, which is also in a safe jurisdiction, is Shell. Take an important note: the lesser you know about the sector, the less risk you must take on. And the bigger the company, the less riskier it is. In our previous analysis, we checked the fundamentals of Exxon and Chevron, and now let's discuss Shell. It has an incredibly low PE of 5.38, about half the PE that Chevron and Exxon have. So for each dollar of earnings from Shell, we get a 50% discount. The dividend, on the other hand, is 3.45%. Out of all company fundamentals, Shell looks to be in the most undervalued position. But remember that a much more comprehensive analysis must be conducted in order to have a clear-cut decision on whether a company is a good investment or not. In general, in times of high inflation, recession or stagflation, it is of crucial importance for each company to have low debt levels, low valuations in relation to its earnings power, and it is best for the companies to pay out dividends. This makes it so that the fundamentals will push up the stock prices and we will manage to beat out the hard economic times with a good investment return. The worst performing stocks during such times are the businesses which have a hard time shaving off positive net incomes, are in need of a lot of capital for growth, need to finance their activities with debt, and so on. With this, we end our analysis. If you're interested in viewing similar content, make sure to subscribe and hit the notification bell so you don't miss out any of our future analysis. Thank you for watching, and I'll see you next time.